Hey everyone, welcome back to another episode. So today's episode is a continuation in our book interview series. So a lot of you guys have heard Terrance Doyle as a guest co-host with me on the past several of those. Now he's in the hot seat. He's the guy being interviewed. So we got Terrance Doyle here. Terrance, how's it going?
Excellent. Thanks for having me. Excited to be here.
And then as our guest co-host, we actually invited Derek Marlin, since Terrance and Derek have a lot of similar backgrounds. You know, they both have done flipping. They both have done some apartment building syndication. So I thought it'd be great for Derek to kind of lead the discussion with Terrance. Since Terrance and I talk a lot, kind of want to hear Derek ask those questions as well. So we are going to go through Terrance's chapter in the book. So Derek, glad to have you here.
Chris, thank you for having me. Terrance, thanks for letting me quiz you.
Yeah, let's do it. Yeah.
And before we get into that stuff, we're having some fun today too. Somehow one of us mentioned to have a couple drinks while we're doing this, so we are drinking some type of whiskey while we're drinking this. So
yeah, that's a good idea.
With all of us being in lockdown and COVID, we're all getting a little more bored and
we
need some happy hours.
Spice things up.
That's right.
We're multitasking.
That's right.
Efficiency.
All right. So Terrance, I read your chapter like half hour before we started recording this and hit some stuff and things have some changed on here.
That's right.
So I kind of want to read the first thing. I'll let you take it over, Derek.
Yeah.
You said your goal for 2019 were close on $2, $3 to $5 million multifamily buildings.
Yes.
I don't know what you did in 2019, but I know what you did in 2020.
Yeah.
And it seems like you're blown out of the water.
2019. Yeah, this was just as I was transitioning. Derek, we've talked a lot about this, from my single family focus in Denver to more multifamily. And yeah, so I think when I was brainstorming for, my goals in 2019, I really wanted to try and go bigger, do fewer deals but larger transactions. And yeah, we were successful and able to do that. We had a lot of challenges, failed and made a bunch of mistakes, but we did check that box.
Yeah, well, and I'll piggyback off that. And it was, you put down 2 deals of $3 to $5 million, and it sounds like you did 9 that total far more than that. What would you say was the time when you hit that sweet spot and knew that you were going to go way over that? And was that an intentional thing, or was that, we'll lean back on kind of like our athletic background, did you feel like you were in the flow and things just kind of kept coming your way, or what was that point of inflection where you're like, holy crap, we're going to blow this out of the water?
I wish I was more like you. I think when we were talking during your chapters, you seem to have dialed in a better feel for what your max is in terms of capacity. And I think that's something that I haven't learned to date. And so part of it was just we got going, we got some momentum, and then the next deal just looked, it was kind of like a thing, we have to do this deal type thing. It was like, this is a deal we have to do. We put in this much work into building relationships and having conversations with brokers. When they bring me a deal that fits my box or even is better than what we're looking for, I kind of feel a sense of obligation to do the deal, even if maybe I don't have the bandwidth in terms of, and most of the time when I'm talking about bandwidth, it's just construction, either to manage the construction or the crews. And so and with multifamily, you can do that a little bit more because you have cash flow coming in. So I think in terms of single family, you get hurt a little bit more if a property's sitting and it's vacant and you're just accumulating interest and fees and overhead. But with multifamily, you tend to have a little bit more of an out because the justification is, well, it's cash flowing.
Yeah.
So I'll buy it.
Yeah, that helps.
So absolutely. I'm not saying that when I'm talking to other people that are getting started, I definitely don't recommend that.
Sure.
I think because of, my personality and my tendencies and the relationships I've built, I tend to want to err on the side of being too aggressive, maybe having too many properties going than not having enough to do. Yeah. And that's definitely not always a good thing. But that's kind of been my default mistake.
Yeah, but I don't think that's a bad thing, because I think you can, as long as you have your pipeline full, then that's, you're right, the good problem to have it is to figure out, oh my gosh, we have to do this deal. I can figure out contracting. I think you're to the great point now where you can figure out the money side of things too, whether you need it to raise funds or not. Right. I think that's the hardest part, is people finding good deals, and everybody says, if you can find a good deal, we'll figure something out to do with it. So, good problem to have, but that's exciting. You were able to turn that corner and just keep going and plow ahead and find a way to make it work.
Yeah, it's kind of like when you're talking about Cincinnati, you spend all this time building relationships, trying to build a pipeline, and then once you have it, just because it gets too busy, you don't want to shut it off, and so that's kind of where I was at. I think 2017, 18, I was just meeting with people and talking about, hey, hypothetically in the next year, we're probably going to shut down single family. I really want to focus on multifamily. And then I think it just kind of compounded to the effect, and really paid off in 2019. We were able to do a bunch of deals in our space, in the box that we had drawn up for multifamily. And in 2020, it's thankfully continued. And I definitely feel like the the medium for me is, I got to find, the balance between, doing really good deals and then still being able to say, hey, this one, we're just too busy. And what I've done recently actually is just put out delay due diligence.
Okay.
And
Nice.
and then financing. And because of the pandemic,
Yep.
I think, there's some deals we've delayed due to financing, appraisal, third party, other reports. We've had to do phase ones, and a lot of that stuff's pushed closing back 60, 90 days, which has really helped
that's good.
the rhythm we're in terms of construction and property management. So I think that's one of the things I learned is coming from single family, I used to just be close quick, really fast due diligence, and it was kind of a speed game. And with multifamily, I've been able to slow it down, say, hey, instead of 7 or 14-day due diligence, give me 45.
Right.
Hey, you know what? We need a 30-day extension on this for whatever reason, and that's really helped out as well. Being able to stagger everything based on just having longer due diligence and longer close times.
Well, and talk a little bit about, I think that'd be a cool, interesting perspective to get from those looking to get into multifamilies that, you're right, you and I still do a lot of single family flips. You almost have to jump on off-market opportunities. It seems to be so incredibly challenging to find good deals, and everything leads towards off-market. We still do a lot of on-market stuff, which I know you did when you were doing single families. Maybe talk a little bit about when you go into the multifamily space, it's a nice transition, or at least what we found out of state, and it's been a little while since I've done it in state, of working with more traditional brokers, not feeling you have to make a decision that second, having, you're right, a 60 to 120, maybe 150 day runway, getting pocket listings of good relationships like you talked about. So talk a little bit about that nice transition that we saw that I'm sure you're probably reaping the benefits of, instead of, oh my gosh, here's an off-market opportunity, I got to buy the house immediately, and you're just frantically trying to do that. Can you talk a little bit about your transition of multifamily?
Yeah, it's so true. When we started in 2008, we literally had to make a decision in 5 minutes at the public trustee sale. You're in the courtroom. There's 10 other people bidding, and you have to decide: am I going to go up 5,000, go up 10,000, or are we just going to bow out? And you spent a week preparing, running comps, driving the property, getting the cash to bring the cashier's check. So I think coming from that, that was kind of my training. 2008 to 14 was making decisions literally in 5 to 10 minutes, and then you transition to wholesalers and brokers on the residential side. Maybe you have 3 days, right? So that felt like an eternity. And then going from single family flips to multifamily, there's some deals that, like you said, we've been under contract for 120 plus days. And what I've learned from that is you get to gather much more information, which just makes you better at executing the business plan. So it's actually been great. Nice. Even though I never went into a deal thinking, okay, I'm going to try and get 120 days, just with the natural delays we've had this year because of everything going on nationally and globally with the health crisis, we've been able to have so much more time to drive by the property more, to understand the tenant class there, to understand their payment habits, understand the maintenance issues. We've done phase 1 reports, which is the first time we've done that. Now that we're taking on institutional investors, requires more due diligence and more just granular, checking boxes, And what that's done, even though if it was just my own capital, I wouldn't do it because I wouldn't want to spend the $5 or $10 grand that it takes to do those tests. What it's done is just made me much more knowledgeable about the area, about soils, environmental, and about that specific lot and the history of it. So it's only added, I think, to my acumen and the knowledge I have of the market and understanding the progression of how lots go from being entitled and then building and then different permits. And those are all the things you learn on a phase 1, which when you're doing single family, you don't even know what a phase 1 is, and you don't need to, and so I think those are things that I've really enjoyed, even though it's, sometimes reading 80 to 100 page documents is obviously a snooze fest, but it is really good, for people that want to grow and just always learning and just picking up new tools of the trade. So I would say that, speed is normally what our advantage was in single family, is we could close really quickly with the capital. We could make decisions really quickly. I could basically walk into a property and probably like you in 20, 30 minutes be like, oh yeah, this is a deal, and I may be within 10 to 20% of the budget I had in my head, but it didn't really matter as long as we got our number. And in multifamily, it's been a complete change, which I think is good. It's just, it's a less likely chance to make a mistake, because of the time.
Yeah, and I think an interesting thing that would be curious to look at what you've done this year and what you think you'll do in the future too is, so you're originally doing that, $1 to $2 million acquisition price. Seems like you've definitely jumped upstream and are doing bigger stuff. Do you find in Denver, what's the sweet spot, and are you trying to stay under this radar of where other institutions are competing with you of your purchase price of, let's say, $5 million is your ceiling? Mm-hmm. But like you mentioned earlier, you want to do less deals, but larger and hopefully more profitable deals.
Right.
Do you have kind of a sweet spot of where you've been leaning in 2020 and where you think you'll go in 2021 of purchase price by staying under institutional, above kind of that mom and pop, and where that has been successful for you?
Yeah, we think a lot about that, and I think it's a scale that's definitely moving. I think if you look at single family, a couple years ago, we used to say, the sweet spot was really being under like 400,000. Under 400,000 is a sweet spot. We know we can sell it under 500. And I even think in single family that's probably moved to maybe under 600, or it's probably just because of prices have gone up and capital's gotten so much cheaper.
Yep.
Right. So then naturally more people can qualify and can afford that, and hard money lending's gotten so much easier. And there's all these national lenders now, and they're funding 90% of purchase and 100% of construction. So now you can have much less capital and buy that deal in the 5 and 6s, whereas before, maybe there was less competition. Mm-hmm. I think it's the same thing with multifamily that I've seen. Back in the day, if we were going to close in cash and it was over $1 million, there wasn't many people that could move as quick as us as far as making a decision and due diligence and closing, because we wouldn't have to get an appraisal.
Yeah, nice.
Just because of the condition of the property and the rents, probably wouldn't qualify for some of the prices we were paying. But I think even that now has changed to where there's a lot of people willing to close with cash or with hard money in the $1 million range. And so I think we're probably more, I'd say our competitive advantage among mom and pops is probably like $2 million, 2 to 3. And then institutions are most likely not looking at a deal under $10 million.
Nice. Okay.
I think there's like family offices and wealthy, private individuals, but most of those guys, because of the amount of capital they have to deploy, under 10 million just doesn't move the needle for them. Yeah. And so I think, if we play in that space where we're above the price that most mom and pops can pay for something cash and move quickly, unlike, let's say, a 4-plex, 6-plex, 10-plex, and we do a lot of those. Yep. So I'd say between $1.5 million, $2 million. Okay. I think that's a little bit more than most people are able to come up with in 30 days. Yep. And then I would say, under 10 million, 10-ish. We're able to, there's not, when I've asked brokers that question of like, hey, where is the sweet spot for guys like me? How many other buyers am I competing with, in the $5 million range where it's, a really low cap rate going in, a ton of CapEx, really low rents, a bunch of work, and a tenant class most people don't want to deal with. Yep. How many people are looking at, and they've told me anywhere from like 3 to 6.
Okay.
So nice. that's nice.
Yeah.
That's a nice.
That's good.
3 to 6 in the Denver market with a couple of the brokers that we work with. And obviously we try and stay with local brokers, not the national guys. And we've had more success with that.
Smart.
So I'm sure the national guys would say they have 10 guys like me, but we're not really, those aren't the guys that I'm really trying to go deep with. Yep. But so that's been, I don't know, what would you say? I mean, you're Chris, you're dealing with a lot of smaller multis now. I mean, would you think that $1.5 million to $2 million, if you're closing quickly, if the property want to appraise, would you say there's an advantage?
Yeah, I mean, I think there is. I mean, just because of exactly what you said, especially a lot of people, when you go from that, 4-unit residential to that 5-unit commercial, that's just a big bridge to go over, and there's, everything changes. So it's a lot of people staying under, 4 units, and that 5th unit range is like the divide on things. Right. So
because you can't get a residential loan at that point.
Yeah, everything changes, the terms changes, different underwriting, different lending, all that stuff. And for a lot of people, I've noticed for investors, that's just they're very comfortable with that range. Right. Again, the bigger world, it's a different game to play.
Yeah, that's interesting. So that's a good point. Yeah. So the number of units, and the price point
helps.
Yeah.
So I got to take a time out here. So Joe Massey's here in the studio, and we have to say thank you, Joe, for the whiskey.
This is legit.
Libations.
Thank you.
I don't have a microphone, so hopefully they can hear me.
Yeah.
I don't think they can. They might be able to.
Yeah,
but
right.
grab that microphone and say hi. So what we're doing, Joe, if you want whiskey or vodka, there it is as well.
Perfect.
So we
That's
texted
really the
Joe.
reason I came up.
We texted Joe 5 minutes for the podcast. Hey, can we come down and raid your bar? He's like, sure. Then he FaceTimed us and was a gracious host. So Joe, we're interviewing Derek and I are interviewing Terrance right now on his transition from, talking about his goals in his book, and we're just talking about the kind of like Terrance is finding the $2 to $10 million sweet spot for things right there.
I love it. Well, I'm just excited to be here to listen, hang out, have a few free drinks, from this mysterious bar that you guys found somewhere in the
mystery
office.
bar.
But no, it's you're doing a great job, man. I love seeing what you're doing, love hearing everything. I loved your chapter in the book. So I'm just going to hang out and listen, but just wanted to say hi.
Thanks, Joe.
Well, let's talk about your venture into building out your own property management company.
Yeah.
And what I love is that we've also gotten some of the same parallels of you've done that in Des Moines. You ran your property management company the way that you wanted to. You built it out. You went the Denver route, but then you pivoted and realized that it just didn't fit your model. Talk about kind of the same inflection point of, was there a specific occurrence where you said, that's it, I'm out, something that was super frustrating that can sometimes happen, or was it a couple of things that just said, you know what, this just isn't worth it, we want to go back to third party, where do you spend your most efficient use of time, and talk about that in-house versus out-of-house, because a lot of people want, think that's the route to go, and sometimes it isn't, sometimes it isn't.
Yeah, and I think part of being an entrepreneur in real estate or any industry is you got to be willing to fail quickly. Just realize, hey, this isn't working, and then pivot. And you're going to try, I'm just an idea guy, so you're going to try a bunch of things throughout the course of a year or your career that are not going to work, but it's going to help you get closer to the right answer.
Yep.
And I think just being okay with failing, like, hey, that we tried it didn't work out.
Yeah.
And so as we were scaling, and I think part of what happened in Des Moines, and for people that haven't heard, we lost, I think, hundreds of thousands of dollars. I don't know the exact number, but it was a lot.
It was that big of a
Oh,
chunk?
yeah, I remember in 2017 we had 120 doors, and we were getting, he was depositing, the company that we were working with in Des Moines was depositing like on average like $18,000 to $20,000 a month, and there was just massive vacancy that people he was putting in, weren't paying, or there was just delinquency, vacancy, the maintenance, would be just like insane. I think one month we had like $36,000 in maintenance on 100 and some doors. I mean, it was out of control.
Yeah.
And I remember, and I would fly, and at this time, this was before I had kids.
Yep.
I was flying back to Des Moines like every other week, and I'd be sitting there going through this document and be like, how did you approve this? And what I realized, which was a painful realization, was that no one is going to care about my properties as much as I am.
Of course.
So he's, someone else, just because there's fires and tenants are calling and they're having issues, they're going to pay whatever they have to in the middle of the night just to get it solved so their phone stops to ring, right, to put out the fire.
Yep.
And I don't actually blame him for that. I get
to a
it.
degree, sure.
He has a fiduciary responsibility to do, I think, better, but I get it. And so even though I'm going to be anal about every single dollar, and that's what I tell, every single dollar matters over the course of a month and a year and several years. Those $100 increases in maintenance add up to thousands and thousands of dollars, and the same thing with delinquency and the same thing with vacancy. Those $700 a month units that sit vacant for 2 or 3 months over the course of hundreds of properties and multiple years is hundreds of thousands of dollars. And so that's where I get that number is we lost so much money just incrementally and what it compounded to. And so I just a light bulb went off and said, if I'm going to expect to get a great return on this investment, I'm going to have to do it myself. I can't expect, it's like negligent of me and almost ignorant of me to think that someone else is going to manage it as closely as I am. I can't expect them to grind over every dollar the way I do because it's my money, not his. And really, he's trying to run his own business profitably, and that doesn't mean he's going to spend 30 hours interviewing plumbers for me, you know? And so, but even though that was my expectation, so part of it was just being a property manager, you know, is just when you're a landlord and you realize all the expenses that go into it, and you have enough doors and you want to do it full time like I was, and you want to grow aggressively, you just have to make a decision. Am I going to be okay with someone not caring as much as me, or do I want to just do it myself? And then I just blame myself. And that was the decision we made in Des Moines. And so then in Denver, we were like, okay, it's a no-brainer. We're just going to do it ourselves. What I didn't realize is that there has to be economies of scale. You have to have a certain number of doors for it to make sense to bring it in-house. And so what we realized in 2017 and 18 was that if you're playing in the 50 to 150 door range, it doesn't really make sense on the expense side, even though we were having higher occupancy and much lower overhead on a per door basis than I would have third party. We were net probably just breaking even based on having all these people in-house.
And a lot more headache for you too.
More to manage.
A lot more headaches, a lot more
calls.
So
what do you think, what's the tipping point?
There's a lot of different opinions on that. My opinion is currently, as I sit here today in August of 2020, I would say 250 units is where I'm at. And once we get to 250 in Denver, we'll bring it in-house and we'll be able to, because I really want to hire A players, and I think to do that, to justify that expense, I think you got to be over 250. And so what we've done in Denver is find a really good third party that cares enough, maybe not as much as me, but they care really close to that. Yeah. And we've been able to align interest as much as possible regarding leasing and vacancy and really aligning interest on NOI. So the higher the NOI, there's bonuses and certain metrics for, the company to trigger. And I think that that's as close as it's going to get for a third party to, for me to feel like it's my own company.
So you give your PM a little bit of like performance bonus based. Is that what I heard?
Absolutely, yeah, absolutely. I'm leasing up. Yeah, we have a new building that's vacant right now, and we set a goal of, hey, sign this many leases in 30 days, and there's a bonus for the team, and then on the monthly overhead.
Fourplex?
That's Wyandotte. We filled the fourplex actually in one weekend.
Really?
Yeah.
Okay. Oh, so you'll fill Wyandotte now?
Yeah. Now we're going to fill Wyandotte. Yeah. So that's what I found. And like I said, we're still learning. We're growing. In a year, I could have a different answer. Sure. But as I sit right now, I think that's, to date, everything that I've learned, that's kind of where I land.
I want to do a quick time out because we just mentioned the apartment building on Wyandotte, which is the Highlands. So 2 weeks ago, we just recorded a Bigger Pockets Ride-Along show with that.
That's right.
So sometime right when this podcast releases, that will be released as well. So be on the lookout for the Bigger Pockets channel for good. We'll link to it.
Possibly the most painful project I've ever done, but I'm really I learned a lot, and I'm really thankful for being done, and it actually turned out a lot better.
It turned out great, but I remember between scenes there was definitely some cursing in there, like, oh yeah, no, we're not talking about that. Too many bad memories.
Yeah,
we got it done.
Some
but
PSD from that property. It's been painful.
Well, what I like to hear is that you're going, I shouldn't say against, but a little counterintuitive to conventional wisdom from time to time is that a lot of people listen to similar podcasts, do similar types of research, studying, but there's I think a big component of just doing it yourself and then deciding that, I think it makes sense to bonus out a leasing agent to make this deal work. Or I think that's the takeaway for our audience is that you don't have to do things the exact same as other people. Like, for example, when we moved to Cincinnati, they had all these residents that they just inherently couldn't get out. Right. And so we said, well, let's just give them a full security deposit back and a security deposit bonus to get them out of our unit. And the property manager looked at me like I had three heads. Right. It's like, just like you said, little amounts of money add up. And if I'm giving that guy or woman back a $700 deposit plus a $300 bonus, $1,000 makes a huge difference in the world today. Yeah. When I'm renting that apartment for $600 or $700, let's turn it and let's rent it for $1,000. And in 2 months, we've made our money back. I love how you look at
you have a better tenant in there. Yeah.
You're right. You have the tenant that you're picking, but I love how you think about it differently. That we don't all have to go down this same path, and you can veer. And sometimes it's almost, too easy for us to realize that, and people just don't pull the trigger. So I think that's a really cool thing that you're doing of looking at it differently.
Yeah, the herd mentality, this is kind of one of my, not to go down a rabbit hole, but just contrarian as far as even like higher education. I just think the herd is always going to say to go where they're comfortable and where they're used to going, but that doesn't mean that's always the right answer. And you may try and go the opposite way and realize, hey, there's a reason why everyone's going the other way. I need to get back on that track. Or you may find out that it's way beneficial to go, the opposite way of the herd. And I just think being in real estate, it's one of the great things is there are some quote unquote book right answers, but you can make your own right answer, just depending on where you're at, your personal situation, your financial situation, the market. And there's so many ways to kind of create your own path and add value and add margin in so many different ways. And I think that's, one of the things that we enjoy doing.
Yeah. Well, and I think that goes back to what Chris originally brought up to us is we all wrote a chapter in this book. And then COVID hit, and it was published before that. And so what I would love to hear a little bit more about is we're kind of doing this recap. How have you weathered, let's call it the first, if we go to a sports analogy, the first inning or two of COVID and some of the pivots that you may have made. And now I feel like we're maybe in the second or the third inning. Are you continuing to go down the road of those pivots, or are you already seeing, dang, maybe we actually want to pivot again, whether that's leaning back towards your original business model that you set out in the beginning of 2020, or it's a third route. Talk a little bit about those pivots and either re-pivots or scrapping the whole damn thing and doing something different.
I think what's also interesting is that in 2019, my previous business partner, who's still a close friend of mine, and we have known each other since college. Nice. He just made a life decision and said he wanted to spend more time with his family and had made enough money and just really didn't want to be in the day-to-day, hand-to-hand combat of real estate that we're in. And so we were just in the third month of where I'd hired basically 3 people to replace him. He handled basically all the back office, bookkeeping, accounting. He was a licensed realtor. He handled a lot. And so, I'm in month 3 of this transition, 3.5 months, and then everything shuts down. And so it was, and most of the people that we had hired were really good at what they were doing, but they didn't totally understand our model. Right. Which is, you can be in real estate for 20 years and get into like value add construction, leasing, and aggressive growth, and be kind of be deer in the headlights a little bit. And so it was really interesting. I mean, it was super challenging. And so I think that looking back on it now, it made us a lot stronger. But in the middle of it, we were, the 2 or 3 things I think that we learned were that we have to be much more disciplined about the location.
Yeah.
The properties that we purchased in Denver, in core neighborhoods, let's call it like we were talking about earlier, like a Congress Park, a Cheeseman Park, maybe West Colfax, within 5 minutes of downtown, areas that are really developing, that have good walkability, where there's a lot of things to do around there. I just think close to transportation, public transportation, things like that, parks, those areas did really well. I mean, I think we finished 2 or 3 projects in April that leased up in 2 or 3 weekends at market rents, so that was great. And we had other properties in other parts of the city that we were not as disciplined in the locations, and those properties are the ones that had a lot of vacancy, a lot of delinquency, and a lot of the tenants that were having issues making rent. And so coming out of, because I think the last 4 or 5 years, it almost hasn't really mattered where you bought in Denver.
Right.
If you did a renovation, you were going to fill it up really quickly, and you were going to get your pro forma rents, if not more. And so March, April, May, that was not the case. So it's just a great reminder that you still have to stick to the fundamentals and be disciplined, and be disciplined in location, in your underwriting, be really conservative. And I think we tend to be conservative anyway with rents, but what we haven't been disciplined in, and I think same thing came from flipping. I think you could basically buy a property almost anywhere and sell it in Denver. And so we thought the same thing with rentals. And obviously that has not proven to be the case. And so moving forward, we've really become more disciplined as far as really location specific and how we underwrite that. And so, that's good. I mean, I think before that we would just almost do a deal if the numbers made sense anywhere. And now that's not the case. So that's been one really good thing. And I just think whenever you go through challenging times with a team, a group of people, it either makes you kind of see what you're made of, and it makes the team hopefully a lot stronger. Or you get to see who's not going to make it, and it weeds out, the people that just shouldn't be part of, this is a good word, culture is a big thing that we both talk about. And I think that was a good thing, is we were able to see, okay, who's really going to fit this company culture long term, and who just isn't made for what we're doing. And we really defined our culture, I think, through March, the pandemic, and we came up with basically just high integrity. Right, so we want people that are trustworthy, we can trust and count on.
Did you actually make like a list of what you're
we put it up in the office. It was 3 things. It was really simple. It was high integrity, so people that are honest, that we can trust, we can count on. High energy. And high energy is kind of like capability too. Like, are people capable? Do they enjoy what they're doing? Are they passionate? They bring good energy. And then high intellect. Are they talented? Can they do the job?
Figure something out.
Can they figure it out?
A lot. If you get the right person, you can train them the specifics of what you want, but you're looking for the good mindset, the big picture, the team player, high integrity. Yeah, you can teach them nuance of what you're doing, right?
100%. You can put them in a room and they'll figure it out. And I do think that we're kind of 3 or 4 months out of the heat of it, and I think we've got those kind of people on the bus right now, and it's been really good, and it's been awesome to see how everyone's kind of come together. No one, as running a small organization, we all wear like 20 hats, so this whole thing of like, that's not my job, that just doesn't ever, that you can't even think that to be
Don't
on our
say
team.
That out loud.
You can't ever even like cross your mind.
Right.
Oh, that's not, what are you talking about? That's not my job. It's like, no. This is everybody's job, you know? And so I'm thankful that we've been able to find those kind of people. And, they're just passionate, just like I said, high integrity, high intellect, and high energy, high intellect, high integrity.
Well, and I think that goes back to something all 3 of us have talked about this probably at some point or another of, the E-Myth Revisited book of working on your business and not in your business as much. Did you ever have a point too, and this is something I've always kind of asked everybody in these informal conversations, is taking time that COVID gave us to step back and reflect a little bit and working on your business versus in your business. And I think that really folds well into hiring and making sure you hire people with the right values. Maybe talk a little bit about when you were making those decisions. And I think there's a lot of people out there that were all like us at some point of going from a one-man band to your first hire, which is obviously super important. But then if you're making your 10th or your 20th hire, you're right, you got to find people that can do a ton of the work and be very skilled. But if they don't fit your culture, then you're probably just treading water to some degree, or they might leave. And how do we find vested employees? Talk a little bit about your next round. I know you and I had talked about before you made that jump, but you just went over those 3 different core values. Sounds like that's paid off, and maybe a little bit about how that's giving you hopefully a strategic advantage to keep people on board versus just, okay, good resume, technically sound, I can train them and then kind of have them do their thing. I think that's what a lot of people look at as, great, they're self-sufficient, but that's maybe not the best route. Tell us a little bit about your organization and how that works.
Yeah, I think it came from just hiring the wrong people. That's how we got to those 3. I think,
those are the best learning.
When I looked back at it, my CFO, who's been on the podcast before now, is he comes from the military. He was actually a Navy SEAL for 10 years, and I just really respect him. And him and I would just sit down and say, hey, why did this not work out with this person? What were the things that we did not enjoy or didn't fit? When we would be with them, and then we'd say, oh, they didn't have this or they weren't this, and then we'd say, okay, what is it that we're looking for? And I think reading the book Traction, which you gave me, and just listening to podcasts and talking to other entrepreneurs like yourself, like Chris, like Joe, and just a lot of people that have bigger staffs. Because I would say that management is not my deal. Actually, my least favorite part of what I do is managing other people. I just think human beings in general, human beings in general are just difficult to manage. We're emotional,
sideways fast.
We're insecure. It's just like all these things come up. It's like that's why I love real estate, because it doesn't get emotional and there is no real there's can be issues with the foundation of the plumbing, but they're not going to talk back to you. They're not going to call you in the middle of the night. It's just brick and mortar. It just but people are not like that.
Tenants will, right?
That's right.
Yeah. Good point.
So I think it's just something that over time I've just had to really look myself in the mirror and be intentional about analyzing. Hey, what are the people that didn't work out? Why? What are the people that I'm drawn to? What are the people that I work best with? What are the kind of people that I want our company to be known for? And so that's kind of where we came through. And I think just having those fundamentals and that foundation down, I think starting with yourself first, right, is just being self-aware and saying, here's what I do really well, and here's what I don't. So let me hire someone that does that skill set really well, but is still like high integrity and high energy, but maybe their intellect is in a different skill set than mine. But you just have to realize that. I think first of all, the first thing is, hey, what do I enjoy and what am I really good at? What's the highest and best use of my time? And then let me bring on people around me that are strong in those other areas. And then I think from there you can build on, okay, what are the next, what's the next area that we need, and what are the things that we didn't do well with that last hire? What are the things that, and I think in every hire that doesn't work out, you can look at yourself and say, I could have done this better.
Sure.
But then we need this from the person, and so I think it was just a lot of trial and error over the course of a long time. That's one thing that my brother's done in Des Moines really, really well, is just he's a great manager of people. I think that's actually what he enjoys most. He's not as much about the deals and growth. He loves managing people. He comes from a coaching background.
Okay. Yep.
And so he loves that. He loves being able to coach people up, take them from let's say a 6 and bring them up and where they're playing at a 9. He really, that gives him a lot of fulfillment. Whereas me, it brings me a lot of fulfillment just to get things done and see growth. And so being able to slow down, be intentional. But it's hard. I mean, we're going to sit here in a year and I'll say, man, I messed up on this in November. I messed up at this, and now I'm trying to get better at managing this. It'll never. I think it's one of those things where you're just constantly trying to improve. I mean, Chris, I know you're adding a lot. I mean,
you're scaling too.
Oh, I mean, you and I are definitely have a lot of similar personality traits on there, and I agree. I think just you get the right people on the bus, and what you said a few sentences ago, hire out your weaknesses.
Right.
Like, I'm really good at a few things. There's a lot I'm okay at. There's a few things that I am not good at or I don't enjoy. And I want to focus on the things I'm really good at. I'm great at networking, deal analysis, financial modeling, creating opportunity, creating deal flow. When it comes to day-to-day deadlines, as everyone on my staff knows, our clients know, that's not my strength, is dates and deadlines and contract details.
Right.
Just not my strength. But like my team, they're amazing at it. They're great. So it's a great partnership in that sense.
Yeah.
I'm curious. I know it's been a while because I was rereading your chapter and I realized that one of your goals was like 12 masterminds with me. And I think we've fallen off the last month or two.
Oh. Have we? I thought we've been doing it every month. Are you sure?
I'll double check.
I think we've hit it every month.
All right.
You have to triple up.
Maybe, but I'm saying we've talked a lot about just like we've like gone through a business expansion and hiring. Do you mind sharing kind of like what your org chart is? Because you've done, I've met most of your employees or people who are working, and I think they're just great people.
Yeah.
Because I think it's been great, the evolution has gone from single family to multifamily. Do you mind kind of sharing the roles you have and the high-level positions and roles they do? Because I think it's really fascinating.
Yeah, and I think going back to the previous conversation about property management, one of the decisions we made during COVID, which I think we'll see in the next couple months if it was the right move.
Yep.
But we went away from, hey, let's build out our own property management company to let's build out a construction company.
Yeah.
And we really, I think I kind of just woke up one morning and I was like, yeah, I need to build out the infrastructure, because I realized that I was spending a lot of time and energy on in construction.
Of in-house crews, you mean?
In-house crews, managing it, bidding it, the ICAs, the insurance.
But you were also you would go from a high-level investor meeting raising $1 million, then you're running to Home Depot to pick up paint and tile for a job site, right? I mean,
and I was answering Home Depot calls 20 times a day. Yeah,
I've
done all that.
I got to take this
really
text confirmation to prove a Home Depot charge.
Exactly. And so and the reason I did that was I just trusted myself more than anyone. And there's so much,
it's
and as you
hard
know,
to step
in
back.
construction, that's the number one way to lose money on any project is you can get so upside down on a project if you do not manage every dollar in construction really quickly. I mean, it can get out of control. So that is why we did it, is I was like, I'm going to manage, I have to be in control, and I just would micromanage every piece of it. And so as, I've grown, and Joe, thanks a lot, man.
Thanks, Joe.
Thanks, guys.
See ya.
These libations.
Yes, that's right.
More drinks.
The
We
podcast,
texted a few.
podcast will get really, really good here shortly.
Well,
It's about
speaking
to,
of this,
it's about to get
like
interesting.
You guys do all the
that's
talk.
right.
I'm just sitting here drinking.
That's right.
So cheers, guys.
That's right. Cheers.
You need to catch up with me.
Yeah, well, and I don't know what you guys think about this, but I always had trepidation of taking on extra expense. You're right. You've got the one side of the coin that says nobody can do it as good as me,
right? Which
we quickly are finding, right, if you hire A players, you can bridge that gap.
That's right.
But I think we're in a fortunate business as real estate investors that people are making large chunks of money to hopefully say, okay, if I'm going to bring on a person to hire, like you mentioned, your back office functions, your bookkeeping, your accounting, some of your office management, do you look at it as, okay, in your world, you have to do one more deal to pay for that person plus exponentially more? Or do you just look at it from a time capacity and say, I'm swamped, I need to bring another person on? Or do you say, hey, it's, I got to pay this person $50,000, and so I need to do one more deal? Talk a little bit about how you see that and use that to your advantage.
Yeah.
Yes.
No, that's a good. And this is part of, and to finish Chris's previous question, this is part of why I transitioned from funding every deal myself in our own company.
Okay.
And doing, a lot of smaller deals in house. Because previous to this year, if I found a 10 unit that I liked that was 1.5 million, I would basically make one phone call to a private lender. I would take it down for 1.5, make a monthly payment. I would bring the construction, and then I would sell it in a year. So I wouldn't make any money basically until that day that I sold it, and then we'd make a lot of money. So there was no cash flow.
Tough cash
right?
flow.
It's tough, right?
It's rough.
But it'd be a bit, we'd have big chunks, we'd have big inflows, but it'd be few and far between, and so it's hard to build a team in that environment.
Good point.
Because you're negative,
right.
then big positive, negative, positive.
Great point.
And so, I had some really good mentors, and they came from an asset management or private equity background, and they kind of took me under the wing and said, look, you have the foundation of a really good business. You understand construction, you have these relationships, you can source a lot of opportunity. What you don't have is a business that you can scale. Because it was basically just me and maybe one other person, because anybody else you hire under that scenario is just increases your deficit every month, right?
Yep.
And so part of syndications is that there's fees that are paid, right? So we get paid a property management fee, we get paid a development fee, we get paid an asset management fee, we get paid an acquisition fee, and we're still able to return a great return to our investors. I mean, we've averaged over 20 on all of our deals to our investors, so it's great for our investors, and then it's great for us because now we can build out a team because we have this income every month to hire people. And it's been amazing. It's really been life-changing, actually.
That's
I mean, this year I've been able to bring on some really talented people, build out a team, because I don't have to really worry about the income, because I know that it's coming in from the deals. The projects that we're doing, our investors are paying the company money to basically execute, to put their money to work. And so it's been a win-win. I get to still deploy capital. I get to do more deals, be more diversified. Instead of having every dollar in a few number of deals, I can do a larger number of deals, spread out my capital over those, and then bring on people to help me execute the business plan, which in turn has made me just a better operator, I feel like, because we have, so many things fall through the cracks when you're trying to wear so many hats. And now I have people that are And like I talked about earlier, now I have a full-time CFO that's trained, has a master's in finance. He's fits the culture, comes from the military.
Nice. He's a great fit.
He's great. He's been amazing. And then Brittany is our office manager. She also runs our motel. Okay. We have a 95-unit motel that we're converting to apartments.
Oh, nice.
And so in between the conversion, while we're doing entitlements, she's managing that. She's also serving as a transaction coordinator. She can also run to Home Depot or run to a project to check on something or make sure a delivery, gets gets into the project.
So she's handling a lot of the operations.
She's handling a lot of the operations, and then we have a full-time construction manager that's on site. And I think he's more like quality control. So he's making sure the subs are showing up, and when they're doing the work, that it's done right. As you know, when you're doing 10 projects at a time, or whatever the number is, making sure that the tile is done correctly, the flooring is done correctly, the paint, the tech, and all those things, it really matters. And so
that's a full-time job.
Full-time job.
Easily.
A full-time job when you're doing, what we're doing. And then behind the scenes, I brought on a project manager that is helping with budgeting. Okay. He's incredible with the numbers and the spreadsheets. He created all these systems in terms of to make it scalable, to here's how much we're paying per square foot for this trade, overseeing all of the paperwork with the contractors. Now that we're bringing on other people's money and we're fiduciaries, we need to make sure we're protected. Mm-hmm. So making sure every contractor now has insurance. All this stuff, all the minutia that comes along with construction, there's so much, and there's so many ways to get hurt. Yep. And obviously when I was buying a $400,000 house, my exposure was a lot less. And now when I'm buying a $5 million apartment building and putting $3 million into the renovation, now my exposure is a lot greater.
Yeah. Details matter a lot more.
Details matter a lot more. And so what we've done is been able to shore those up by hiring people in those roles. And I've made a really conscious effort to focus on construction.
Smart.
To really build out a construction company where we have systems and we operate, I would guess, I haven't worked for a construction company, but I would guess like a construction company.
Sure.
And to have those systems and processes in place. And I just really feel like that's an area where we're going to be able to create a lot more margin than property management, and that's why we went that way. I think property management is a low margin business.
I agree.
But it's great to control your asset. Mm-hmm. But we feel like we've been able to find a good enough property manager where that's not really a pain point. But the construction, there is high margin in construction. Just saving 10 or 20% on materials versus hiring out a GC that's going to charge you the 10 or 20% and then the labor.
Which one's easier to outsource, property management or construction? It's PM, right?
Property management is much easier. Yeah, construction is so, as you know, it's so difficult. And so I feel good about that right now. Nice. I think we're really dialing in and getting better to where we can, we're just building the foundation of a construction system that we can scale. And that's really the goal, because I think that's where our niche is we take on projects that most people either don't have the capital or the patience to deal with.
Well, and that's a great point. I don't know if you've come across this, but when you do that level jumping of when you really exponentially grow your business and you're talking to other investors and you're trying to tell them, hey, I want you to invest your money with me to buy a $5 to $10 million piece of property. I don't care how charismatic you are, and you are a charismatic dude, so definitely don't take this the wrong way. But I think they love to see that charisma with leadership coupled with a team to know, you're right, they can pull this whole thing off, or that you can pull this whole thing off. Because if not, they're saying, how the heck am I going to deploy $5 million with this guy? I don't care how good he is to do it on his own. Do you feel like people have been receptive to that and said, it'll help you grow your business, help you acquire more deals by building the team, and then you get your time and sanity back too?
Well, that's the number one thing is, we have a 10-week-old son at home.
Right.
We have a 2-year-old daughter. I have a wife that I really want to spend time with, and I want to enjoy, it's like you can get so busy doing deals. It's like people that maybe do half the number of deals I do, but they enjoy a better quality of life. And so I think that's a great point is, hiring the people has allowed me to, I think, just become a better operator and a better fiduciary, and as well as made me a better husband, a better father, and I think a better leader, in all those areas. I just feel much more balanced, as opposed to everything hinging on me, every single day. Now we have a team of people, and if there's an issue and a fire they can't put out, they're calling me, and it's I think added much more margin to my day-to-day, which in turn has helped me be able to look for more opportunity. Instead of every day just putting out fires, I think I'm still putting out fires. And I think as an entrepreneur, we always will be putting out fires.
Right.
But I get to balance that with brainstorming more, being more creative, trying to think about ways to improve, to grow, thinking about ways we can get better, as opposed to just being reactionary every day and just reacting to fires that come up. And so I think it's been received well. Thus far we've closed on, I think, 4 syndications this year, and each one has been oversubscribed. So we're really thankful. And one of the concerns that has come up is how's the team? If something happens to Terrance, who's gonna run it? And I'm really thankful that we've been able to bring on the right people. We're training them, and that if something were to happen to me, I feel really confident that, maybe the team wouldn't be able to create as much opportunity, because
Sure,
that's harder to
that's
replace.
your sweet spot.
Yeah. Maybe they wouldn't be able to create as much opportunity, but they'd be able to execute on the projects we have, and possibly do it better, because they are more detailed, more thorough, and when I was managing every aspect, a lot falls through the cracks because you can only focus on so many things. So I do feel good about that. Obviously, we're just like everyone else. We want to improve, and there's areas that we need to get better at, and we want to. But net, I think we've grown a lot in those areas, and we've brought on some good people. And so, I'm really excited.
Nice.
I'm excited to be able to execute more and do more projects and put our team to work and really provide some great returns to our investors. And that's really what it's all about. Is being able. I want to be a good steward of my own capital, and then I want to be able to be a good steward of other people's capital and get them the best return possible. And that's really what drives me right now.
Well, and I think that, and I feel like there's been a lot of personal development people that have used that, 4-box matrix of working on the stuff. But I think it actually goes back to President Eisenhower of working on something that is important but not urgent.
Right.
And so if you don't have time or the headspace to do that because you're running around doing everything, then I think that you can only grow so much and you continually hit those ceilings. So I think it's just so cool to see.
What was his message?
So I believe, and I'll have to go back, and I want to.
I've not heard.
I'm probably ripping this off from somebody else, but it's
just get close. Just get close.
I'll give many people credit, and so that I won't get discredited. But I know a lot of personal development people have done it where you draw 4 boxes, and you've got the not important but urgent, which is just your general tasks and your busy work. And you're like, dang it, I have to get this done. This is taking forever. Just get it off my plate. But you want to work and live in that top right quadrant, which is things that are important, but they're not actually urgent. And that's where your strategy comes in. That's where your long-term thinking comes in. That's where you can see shifts in the market. And I think that's where you've done a great job, is being able to build out that team and focus on that stuff, which in turn, you're right, you walk an investor through there and say, I am going to be a good steward over your money because I've got this headspace and this time and this infrastructure to work in multiple markets, work in multiple parts of town, do different asset classes. So I think that's been really cool, to kind of see from afar. And none of us have, the right headspace to do that enough, I think. But I think you've done a really good job of carving out time to do that. And I can just see it come through.
Thanks, man.
The way you're running things.
Yeah, well, it's been, thanks to you. You gave me that book, I think, a year ago, and that was definitely part of the process, of trying to think about things the right way. And
which book was that?
Traction.
You mentioned it to me like 5 times.
No, it's good.
Yeah.
I think I still have it, actually, so I could give it. I could pass it on to
keep
him.
it going. Keep it going.
I was supposed to return it, so I'll bring it next time.
No.
Great.
Whoever
Traction
can get
great,
more, get more use out of that. That one really definitely helps. I think people run either a small 1 or 2 person business, and I hear people that run 100 people businesses with that type of management philosophy. And it's just straightforward, common sense, not overly complicated. And the funny thing about that is I know you guys, have gone to different good schools, and, I went and got my MBA, and I felt like that Traction business model, which narrows it down to a 2-page business, is actually more efficient than what you learn in getting an MBA from time to time. So it's definitely big.
That's my next book.
Big thing to go.
During COVID,
route
while you college students are not going to college or paying a bunch of money right now, rewind that clip 30 seconds because it's something we talk about a lot.
I agree.
Just chit chatting. So So
I
guys,
totally
we gotta actually wrap up about 5 minutes or so. I could drink and talk to you guys for
this has been good.
Yeah, absolutely.
We should probably plan that one day. But we got some appointments coming up, so we have to wrap up here eventually. So I know you got your checklist. I'll let you kind of wrap things up here because I enjoy sitting here drinking and listening to you guys chat. This is great.
Well, I think
Chris has got a good seat.
It is. It's a good. It's a good view from where you're at.
Sports games right now, so this is
no.
This is it.
Right.
I just really appreciate you guys inviting me on and being able to participate in this. And I think that what I would just end this whole thing on is I think we've talked a ton about great actionable items that people can use, whether they're just starting out or whether they're scaling their business. But talk a little bit about. Do you have a something that I think everybody can use as an individual? Do you have a morning routine? Do you have a morning ritual? Do you have something that you're super dedicated about first thing in the day or at the end of the day that keeps you sane, keeps you on track? As we've hit all these great business things.
Yeah.
How do you lean that into your personal life, knowing, like you said, you've got 2 little ones, which I know is can be a head full, and you're
That's
right.
the morning routine right there.
Yeah, good point.
I change a lot of diapers
too much
before 7 a.m. I've changed probably 3 or 4 diapers.
Okay,
that's the secret.
That's the secret. right? Just change
Well, I mean,
diapers.
changed today, but we're at the 12:07
I think
right
two.
now.
I think I hit 2 this morning.
Okay,
I think
that's good.
one of the things that really helps me in coming from sports background, which I know you can relate to, is I love to work out.
Yeah.
And I think even though I'm not going to the gym, I was able to find someone to work out with in the park,
Nice.
across the street from my house.
Yeah,
and
me too.
we hit that 3 or 4 times a week.
Good.
And it's been awesome. I think just to clear your head, not have a phone on you, enjoy the
unplugging for a few minutes.
enjoy the
Yes.
outdoors. Yeah. I think breathing is really underrated.
Mm-hmm.
I'm not
Completely
joking.
agree.
I know that sounds
Nope,
weird, but I
I'm
think
with
the
you.
way you breathe is like really underrated, and so I think that's obviously helped me a lot. And I think having a really amazing wife that allows me to be high energy and kind of just want to go really hard every day. Has been amazing for me. And then I think when you hold a newborn, I think it kind of changes your perspective on life. So that's been good for me.
Yes.
So change diapers,
Yep.
get a really good wife, hold a newborn.
Yeah. Whether
And
it's
I
yours
think,
or somebody else's. Just
and really
hold
focus
one.
on breathing.
Yeah.
You got to breathe.
That's cool.
And I think 2 books, on top of Traction,
Yeah.
for anyone that wants to read, that have really helped me the last 6 months to a year.
Is one the 2020 Guide to Denver Real Estate Investing?
That is definitely one of them.
Especially
You should
3
definitely
chapters
pick
in
that up.
particular
Yes.
that are mind
Whoever
blowing.
DMs me and asks for that, I got a couple copies we
That's
can
right.
send you. That's a great book.
No, seriously.
I think that's one of them. Is Ray Dalio Principles.
Yeah, I agree.
He's got some great stuff. I think he's one of the largest hedge fund managers in the world, and he's really big on transparency, communication, just really fundamental stuff. Even though he's a sharp guy, he's fundamental. And then the other one is Sam Zell, Am I Being Too Subtle?
Mm-hmm.
For those that know Sam Zell, he's probably
Who is that?
the world's largest real estate investor. He
Visionary.
owns like 3 or 4 he started the whole REIT thing, but he owns more apartments, I think, than anyone in the country. He
Yep.
started buying apartments when he was 18 in Michigan, and he kind of
okay.
started the whole REIT. He
did.
was the first guy that had
Yeah.
a real estate REIT, and now he has like a mobile home park REIT, apartment REIT, an office REIT, a retail. He's
Yeah.
Are those
he is
private or public? Do you think?
public.
Oh,
Oh, yeah,
public.
equity. Yeah, so I think it's like Equity Residential
Yep.
that's the one that I've invested in,
Right.
is the multifamily one. But his
Yeah,
book is
he's
amazing.
amazing.
It's just a autobiography on everything he's learned and done, and it's really a lot about fundamentals.
Yeah.
He talks about some real estate deals, but he's gone on to even trade like companies. He took the same fundamentals he applied in real estate, and I just think that's a phenomenal book on everything that we've kind of highlighted.
Yeah.
That kind of goes over, and just from his perspective on the real life stories. And obviously he's adding a bunch of zeros to his
course.
deals, but the principles are the same and the fundamentals are the same. And
They
that's
are.
what I really took from the book.
And when he starts out, he's the same as many of us too. You can't just automatically, typically, jump into starting a REIT from
Right.
scratch, but
That's
you
right.
got to earn your stripes and get there. So no, that's been great. Well, I've definitely checked all my questions off. I know we're getting close to the end of time, but thank you so much. It's been super fun to do this interview, and I thank both you guys for asking me on.
No, I always love
thanks,
talking to you.
Terrance.
Yeah, it was great. I really appreciate it. That was fun, Chris.
Yeah, this has been great, guys. I enjoyed it. So both of you guys did a great job. And as a quick reminder, we're talking the 2020 Guide to Denver Real Estate Investing. Somehow it's already August of 2020.
Yeah.
I mean, I
Crazy.
blinked. It was April 2020. Now we're in August. At least we're out, not at home right now. But we're going to be publishing a 2021 guide. So come November, we'll start accepting submissions. I know you two guys are definitely being here for the 2021 listeners out there. Write a chapter, check the show notes, Google it. It's in the link somewhere. So Terrance, thank you. Derek, thank you. Appreciate it, guys.
Boom.
Thanks.
That was great.
Appreciate it.